Welcome to another edition of the Big Cast. My name is Glen on behalf of the Best Innovation Group, where we like to do cool things with financial technology. And this week we have an interview for you with a couple of academics who are digging into topics that are of interest to the credit union space. Anna-Leigh Stone of Samford University, that's Samford in Birmingham, Alabama, and Jordan Van Rijn of the University of Wisconsin. We'll also be talking about the Credit Union Research Workshop, which is where I most recently connected with these two at the end of January. And a great paper about the acquisition of banks by credit unions and the implications of that. You can always find out more about the Best Innovation Group by checking out our website, big-fintech.com. I'll mention again that the CU Unplugged Unconference is coming up pretty soon and coming together quite nicely. That's going to start on March 30th in San Francisco at Visa's Market Support Center. I'll tell you what, I think it's going to be a really interesting and fascinating topic and well worth your time in terms of really digging into the hottest issues right now affecting strategy and operations for credit unions in small interactive groups to come up with some actionable follow-throughs to really make an impact. I'll let you find out more by checking out the website, cu-unplugged.com. Feel free to reach out. I'll be there and happy to talk you through exactly how this all works out so that hopefully you'll decide that it's worth your time to join us as well. The news. And here we go. I think the idea of the 10% credit card cap held my title for the most bizarre policy idea to come out of this administration for about a month, and I can't believe it's already been surpassed by a new one that is suddenly in the airstream. There is now talk of requiring banks to collect citizenship info. And again, this is very ill-defined, emphasis on the word ill. So we don't really know exactly what it would look like, what exactly the requirements would be, why they're doing this. But this is like really complex on so many levels. Let's just touch on it quickly. I'm going to post a link to what I thought was a great article by the Cato Institute, who really kind of picks this one apart quite effectively in my mind. But Scott Bessent, the Secretary of the Treasury, in hindsight, foreshadowed this back in a January bit of testimony to Congress, where he referred to, I love this, doubling down on KYC, know your customer. So here's irony number one. One of the reasons that the business community found the GOP platform appealing was what they saw as excessive regulation and a clear mandate and a clear expectation and promise to reduce the degree of regulation imposed on financial services. Okay, all of a sudden now, if you ask almost any banker, the most onerous of those regulations tends to be around KYC, know your customer requirements, and the reporting of that, and SAR, suspicious activity reports as well. So there, again, it was unclear what Bessent meant when he originally said doubling down on KYC. Well, if you have to track down citizenship information, which we all know is not exactly easy, a driver's license doesn't do it, a tax identification number doesn't do it. We're going to come back to that in a second. That is going in the opposite direction. It's not only violating a promise to actually reduce regulation, it's increasing regulation. Not to mention that this is kind of the definition of debanking, which remains a hot button topic. And maybe it's just a matter of who you're debanking that maybe is what it comes down to. Here's my favorite paragraph from the Cato Institute article. I'll just read it verbatim because I think it's really well stated. To be clear, there is nothing illegal about non-citizens or foreigners opening bank accounts in the United States. There's a starter right there. In fact, it's a good thing that people around the world view the U.S. banking system as a safe haven. Kicking them out of the system would not only cut off a source of stability for them, but also eliminate investment and savings that power the U.S. economy. Let's just go a little bit further on this one, next paragraph. The consequences do not end there. Other countries caught up in the anti-foreign bias would suffer from this requirement. It would perversely encourage informal cash economies, discourage foreign investment, undermine tax and wage compliance, and reduce visibility into real, serious criminal activity. Other than that, it's a great idea. So anyway, okay, so This is very early stage. I mean, who knows? Maybe it's another one of these trial balloons that just kind of goes away quickly. But unfortunately, as we've seen, as the case with the 10% credit card cap, which initiated back during the campaign as a promise, seemed we all kind of hoped it would go away, and it did for about a year until it reared its head again. Still very early, but obviously something that we need to be watching. Cato Institute article, really worthwhile on this one. I'll post a link. You ought to take a look at it, in my view. Two of the other big stories that caught my eye this week both have to do with new product and or company announcements, and I don't think it's coincidental that they both popped up the week before the Government Affairs Conference, GAC, over in Washington, D.C., because I think it's a great opportunity to get the visibility, and I have the follow-up questions, which is exactly what we plan to be doing with them. First off, TrueStage announced the planned launch of their TrueStage stablecoin, fully dollar-backed, one-to-one. The abbreviation they're using for that is TSDA, TrueStage Dollar. Don't know, but that's where they're going with that one. And it is the first stablecoin that is designed specifically for credit unions. It's interesting. It says for credit unions right in the headline of their press release. Later on, it talks about community financial institutions. So the distinction between that may be interesting. Another important distinction, it is not member facing. This is actually intended to be working from back office settlement operations and things like that, which is where I think it makes the most sense to be involved in these things too. So I know there's been a lot of different groups and initiatives kind of trying to tackle this one. Looks like they've gotten first out of the gate in terms of at least the announcement that they're moving forward. Another one is actually a new QSO being set up jointly by the Filene Research Institute, the Viso Corporate Credit Union, and Virtus AI, who we've had on the show before, AI being a key word there. The new entity is called Cultivate, CU in capitals, Cultivate. And the idea is a foundational AI model built for credit unions. The quote that comes directly out of this is, a credit union-specific alternative to generic LLMs, large language models like ChatGPT and Copilot. As we know, AI ain't going away. We have to figure out how to work with it. It's one of those weird challenges because there's this kind of dichotomy right now where a lot of places are going, this is dangerous. We don't want it being used in our systems. We got to be careful. At the same time, you got to learn how to use it. So this is a trust-based approach to try to work within a model that is specifically designed for credit unions. Again, I'm going to find out more about this. There's a launch conversation taking place at GAC. There were three papers presented during this workshop. The one that really caught my attention has to do with the topic that's really gotten hot button status in the industry, for better or worse, and that's around credit unions buying banks and the implications behind that. So we're going to dig a little bit more deeply into that one as well as the conference itself. Have a listen. I'm here with a pair of associate professors, Jordan Van Rijn, associate teaching professor at the University of Wisconsin-Madison, and Anna-Leigh Stone, associate professor of finance at Samford University in Birmingham, Alabama. And I'm following up on a credit union research workshop that Anna presented a paper there, and Jordan helped to coordinate. Some of you may be familiar with Jordan. He used to be a senior economist at CUNA before joining the academic world and the faculty at the University of Wisconsin full-time. Thanks to both of you for taking the time. Really enjoyed the workshop.
Thanks for having us, Glenn.
So Jordan, let me start with you. This was, I believe, the fourth year that you've done this workshop, and I think it's kind of been growing steadily, correct?
Correct. Yeah, we had our first workshop, I believe it was in 2018 or 2019 before the pandemic. So that was, in person, and it was really wonderful. We had a lot of credit union practitioners and academics. We kind of naturally took a hiatus during the pandemic, but then tried to bring it back. This is now our fourth, and yeah, I think we've grown quite a bit. I believe we had about 40 to 50 participants this last time. And, we're getting more submissions, really fantastic research and papers like Anna-Leigh's paper. So it's been quite exciting. The goal is really to bring together credit union practitioners and academics so that we can kind of really merge the research with the practice and policy making. So I think it's been a success. We hope to continue to see it grow.
So obviously you're sitting in the cradle of cooperatives in Madison, Wisconsin, but I'm curious, if you look outside the, that world there in Wisconsin, how familiar do you find that academia is with credit unions? Do you have education process to actually get them familiar, or are the folks that you're working with already pretty well understanding of the structure?
Yeah, that's a great question. I mean, this was really one of the impetuses behind this project was that, when I was doing my PhD at UW-Madison, I was working at CUNA, as you mentioned, and doing research on credit unions, and I found that, wow, there's some really interesting things about credit unions. But, when I tried to kind of share this with others or publish it or submit these papers to conferences, I found that there was quite a bit of a lack of knowledge of what credit unions were, say, oh, they're so small, they're not really important for the economy, or just didn't understand how they're different from banks. A lot of people would kind of lump them together with other just small banks. And it was very hard actually to get my research out there and into these spaces, and I wasn't sure sort of where this credit union research fit. I also started just kind of out of curiosity looking at a lot of banking and finance journals, and I found that, overwhelmingly there were many, many papers on, for-profit banks, but very few on credit unions. And when credit unions were mentioned, as I said, a lot of times they'd just be lumped together with smaller banks, or they'd be, excluded altogether. And you'd see a little footnote saying, we exclude credit unions because they're such a small part of the economy. But you can look at it from different perspectives, right? Credit unions, for example, if you just look at the total share of deposits, it's maybe only 5 or 7%. But if you have, about 4,500 credit unions in the country, about the same number of institutions as banks, about, over 100 million credit union members, probably about 40% of the population of the US is a member of the credit union. Credit unions originate about a third of auto loans. They do about 15 to 20% of mortgages. So they're really a pretty substantial part, very much overlooked by, academia. So that's why, we wanted to create this space for young credit union researchers in particular to share their research, but then also connect with practitioners as well.
Along with the three papers that we discussed during the workshop, you assembled a power panel, I'd say, that I helped to moderate um, around credit union economists, including Navy Federal's chief economist, and also from America's Credit Unions and Emeritus Credit, Bill Hampel, people may remember also from the CUNA days, about really addressing the gaps in the research, as you say, in terms of what the industry might want to know versus what the academic world has been researching. That might be a nice kind of transition to Anna-Leigh. You had a paper. I love the title, "When Credit Unions Cross the Aisle." And why don't you just say a bit, because I thought your paper both was fascinating, but also really relevant to a hot topic right now in the banking and credit union world.
Yeah, thank you, Glenn. So my paper looks at the performance of credit unions after they purchase a bank, which are a relatively few number of transactions that have actually taken place. There's about 74 of these transactions that have happened since about 2012. But they have grown in terms of the number of them. So in 2024, there were 22 potential announced uh, bank purchases by credit unions. In 2025, that number did fall slightly to 16, but still a relatively large number of these transactions that we expect to continue, hopefully, to complete over the coming year. And so I wanted to go in and look at what's the performance of the credit union after they engage in this transaction, because we've seen papers where credit unions are purchasing bank or purchasing other credit unions, they're merging, but given there hasn't been as many of these transactions, there's just hasn't been enough data to study. And I find some really interesting results with this. I find that while initially upon the completion of the merger, the credit union does experience a decline of net worth, I actually am able to document that it's not due to any decrease in performance mechanisms. So ROA doesn't change, liquidity doesn't change, efficiency ratios don't change. And when I say don't change, that's in respect to a credit union merger. So I'm comparing credit unions that purchase banks to credit unions that actually merge with other credit unions to see if these transactions are different. And so what that tells me is that that transaction Well, it is reducing net worth ratios, which is a concern, right? Because we're heavily regulated on our net worth as credit unions. It's actually not because of operating performance. It's because of accounting um, balance sheet effects, where the credit union purchases the bank's assets, they assume the bank's liabilities, and they're not actually gaining any equity in these positions. And so that just causes this natural dilution of the equity position on the balance sheet.
So
And
it's
I think
really
that
just
that's
it's just an accounting exercise, right? I mean, it really, yeah, I could see someone pointing saying, "See, you've just weakened your credit union," but it's purely, something just to make the books balance.
That is exactly right. And that's the fear, I think, in where I started with looking at these transactions was when I saw, oh, they decreased net worth. Even my first reaction as a researcher was, oh no, like that's not what you want to see. You don't want to see that we think it's making these credit unions weaker. But the finding that it's really just a balance sheet effect. And in fact, I've gone in and I've looked at the capital classification. So whether they're well capitalized or adequately capitalized, and I don't see an effect in that capitalization category. And so I think that that's reaffirming that while these ratios decline, it's because of balance sheet and it's not actually affecting the capital classification of the credit union.
You mentioned before it's still a relatively rare occurrence. You've got, I believe, your database, and it's big enough. It's a big enough sample now that you can draw some reasonable conclusions. I think your study at this point encompasses 74 completed purchases. Now that's over, I think, a 13-year period, 2012 to 2024. Do I have that right?
That's correct.
And obviously, like you say, there have been definitely about half of those purchases have probably been just in the last couple of years. And I think you also mentioned that those 74 purchases are across 54 different credit unions. So some have made multiple purchases. And I think you also found there's a little bit of geographic concentration there too.
Yeah, absolutely. I find that a lot of the banks where they're headquartered, there's some geographic kind of consolidation where we're seeing a lot of these banks being purchased in Florida, Georgia, Alabama, and then Illinois and Wisconsin. And so there is some, variation where there are some states where there have been none of these transactions. But there are others where we're seeing, upwards of in Florida 14 transactions
Wow.
over
Okay. So
of
they're
those
like they're
74.
like 20% of the total, basically. Wow.
Yes.
Okay. Wow. Interesting. And I know there's a couple of states that actually prohibit transactions of this nature, but they're few and far between. So that's an interesting point. So you're comparing those 74. How big is your database of credit union to credit union purchases?
From a
Mergers,
credit
I should say.
union merger database, I'm actually looking at, I think by the final sample, there's about 1,000 of them left in the
Wow.
sample.
Okay.
So in terms of numbers, these are very small.
And again, if you looked at the number of bank acquisitions, again, it's a very small percentage of those as well, which is why I find it kind of ironic how much noise is generated by it. But it's a unique thing, and therefore something that it gets people's attention. You also mentioned one other, I think, factor that you noticed in terms of loan delinquency.
Yes, absolutely. So I document that after the transaction, so after the credit union has fully incorporated the bank purchase, about 6, 7 quarters afterwards, there is an uptick in loan delinquencies. And so I dive a little bit deeper into that. And so I look into what is the loan portfolio? How does the portfolio change? And we see that the credit unions take on a lot more commercial loans following these transactions, which is one of the motivating factors that a lot of credit unions give towards purchasing a bank is from the commercial loan aspect. And so I do document they are assuming a lot more commercial loans than they had before, and the delinquencies are really coming from those commercial loans. But I think one thing that's interesting to note there is it doesn't appear that those delinquencies are driven by like credit union inefficiencies of managing the portfolios. They're just natural delinquency rates that tend to happen more so in commercial lending. And so you're just seeing the credit union's delinquency rates have to adjust to this new portfolio composition.
So am I hearing it's kind of a mix issue more than anything else?
Yes.
Okay, that's that. So you mentioned before that, when you first saw the net worth ratios, kind of come down. What was your kind of original, what drove you to this topic that made it appeal to you? And then, how have the findings so far changed the way that, maybe what you thought you might find when you entered into the exercise?
Yeah, so I actually got into this because the credit union that I use in town announced a bank purchase, and I thought,
Oh,
well, this is interesting, right? Like, you don't hear about that very often, and so I was very fortunate that very close after that, the one of the bank officers came to talk to my class about credit unions because I teach a banking class that I slip credit unions into, and so just kind of asking her about these transactions sparked a lot of interest. And I spent time, doing the due diligence of has anyone looked into these? And no one really had from an academic standpoint. So that's what got me into it is, just from my own viewpoint, how might this change the way my credit union operates that I'm using? And so I would say from, going into it, right? Ideally, as a user of a credit union, I would love everything to be hunky dory and it to be like their performance is great and it's it doesn't falter. And so when I first saw that network result, I was a little like, oh no, like what are we going to get ourselves into? But in looking at all the other results, and I go in and even look at interest income changes and interest expense changes and non-interest income as far as are these credit unions then adopting bank-like policies where maybe they're going to start charging less for or paying less in terms of deposit rates or charging more in terms of loan rates? And I find that none of that changes. And so from the consumer standpoint, you're probably not going to see a whole lot of adjustment at the credit union other than maybe a different loan composition that they can advertise now. You're going to keep seeing the same credit union experience that you knew beforehand, and I think that's really reassuring or should be reassuring to credit union members that these transactions, while they're changing some of what a credit union maybe has done in the past in terms of loan composition, your average user of a credit union is probably never going to see an effect of their credit union purchasing a bank, other than just now they have expanded operations.
That's fascinating. If you mentioned that, I did not recall that you actually had that level of personal experience. I didn't even recall that there was a specific case that popped up in Alabama where you're at. So that's really interesting. Now, this is a little bit outside my level of expertise, but I understand this is currently kind of considered a working paper, meaning you're still making revisions and kind of taking further analysis.
That is correct. So I worked on it over the summer as an academic. That's when we have the most time if we're not teaching classes. And so I worked on it last summer and had a preliminary draft, which is what I presented at the conference. And then based on feedback from the conference, I've actually been able to update it and revise it and add to some of the results. And the baseline results have not changed, which I think is great that they are robust to all of the suggestions that I got. And so the goal is that, the conference has added something of value that hopefully helps me publish the paper.
And I guess you got to draw a line in the sand at some point, but you got the 74 that's through 2024. Are you going to incorporate any 2025 transactions and acquisitions, or you don't have enough time to get the 6 quarters and whatnot?
Yeah, due to some of the lag in just the reporting of the credit union data and having to go in and collect some of the information on the transactions, I've tried to keep an eye on it. And at this point, I think expanding my sample would really only add about 6 completed transactions where I would have enough time after the transaction in which to incorporate the data on the changes. And so as of right now, I'm not planning to do that. So hopefully I'll have it published before there's a need to go in and update that data.
Got it. And I mean, you've got 2024 in there, which appears to have been the high water mark. As you said, 2025 actually ticked down a little bit. So unless there's any reason to think that the characteristics are changing in these most recent cohorts, It doesn't sound like that should be a big issue. That's really interesting stuff. So, and this again, this is it's a hot topic, and I would think this is one of those, to your Jordan, to the panel's discussion about the gaps in any kind of a research. This seems to be the type of thing that the credit union industry would be very interested in. What is your thought in terms of what you've seen in terms, gaps that things that academics may not be aware would be a topic of interest to the industry, or that maybe for whatever reason the two might not be thinking along the same lines?
Yeah, absolutely, Glenn. I think this is a great example, Anna-Leigh's paper of how even though there aren't that many of these transactions, as you mentioned, where credit unions are buying banks, from a policy perspective, this is an incredibly hot topic, as you kind of insinuated. The banking lobbyists are going to policymakers and criticizing credit unions for doing these transactions. And so it's wonderful to have some actual analysis and data and really rigorous research about this topic to kind of show people, what are the actual effects of this, and bring in that research side. And so, as you mentioned, the panel also had some really great ideas about like what are some other gaps in the research that academics could focus on. You mentioned we had Bill Hampel, former chief economist at CUNA, now America's Credit Unions. We had Curtis Long, current chief economist, and we had Heather Long as well, of course, which is really wonderful. She's the chief economist at Navy Federal, the country's largest credit union.
And no relation to Curtis, we should probably
And no
note.
relation to Curtis, even though they have the same last name. And so they had some really great ideas. A lot of it was around this idea of like, there's a lot of consolidation in the credit union industry with banks as well. Decades ago, we had about probably 20 to 30,000 credit unions, about the same number of banks. Today, we have about 4,000, 4,500 credit unions, about the same number of banks as well. So a lot of the smaller institutions in particular, it's hard for them to kind of keep up with the growing costs and regulations and technology. So there's a lot of mergers, as you guys mentioned, some purchases and acquisitions. Sometimes there's failures as well, especially on the bank side. And so there's this question of like, as credit unions grow, are they able to really maintain their mission, their nonprofit mission, their sort of cooperative, democratic nature, which is maybe a little bit easier when you're smaller and focused on a small local population, and people feel much more connected to the credit union. So a lot of the research questions are sort of around this idea of like, what is the optimal size of a credit union? Can credit unions sort of stay small and still be relevant? Or as credit unions grow, can they continue to really maintain this connection to the community and really strong sense of mission? And then, we do show in a lot of our research, that credit unions charge much lower loan rates. They have higher deposit rates, fewer fees. So they're kind of a better deal, at least on average, for consumers. So we do have questions around like, why don't more people join credit unions? Do more people need to know about credit unions? And how can they really, how can people be educated about the credit union difference and how they do have better products and services, and they do have a little bit different mission as nonprofit cooperatives? And then, of course, there's some topics I think, Glenn, you have some interest and expertise in around like the future of credit unions, right? With artificial intelligence, what's that going to mean for credit unions? How can credit unions use these new tools to kind of help them and help them serve their members, but then also not create challenges and not make it more difficult, even more so for the smaller credit unions? We have things like stable coins coming out, all of this that might be difficult, especially for smaller credit unions to really kind of keep up with and compete with larger banks and credit unions.
I'm just
So
thinking
lots
that
of, yeah, go
the
ahead.
thing about AI kind of strikes me is it's a little bit of a different, but there's no limit to what we could be looking at in the research here. That feels a little bit more qualitative. It maybe gets more into kind of psychographics and whatnot, as opposed to the rich data set of numerics that we've got to work with from call reports and whatnot. But they're both very valid. I think that's an interesting point. The one that you mentioned, that what is the optimal size of a credit union, is like really sticking in my head. That's a big question and a really interesting one. I guess you could probably carve that up into a couple of different pieces.
Absolutely. Yeah. So, it could be that like I was having a call with a credit union CEO the other day. It was just, a smaller 50 million institution, and she was really saying that, she didn't fully like the way the industry was going, that there are a lot of strong incentives for credit unions to grow and get bigger or merge. And she felt that the industry should try and find ways to cooperate better together so that credit unions can stay small while still staying relevant, keeping up with all of the technology and everything, but still staying connected to their local community. But of course, I know there are many large credit unions that continue to really have a very strong mission as well, have wonderful products and services for their members, have lower loan rates, than banks. Even in some of my colleague Andrei Shahidinejad, he's a co-organizer. He has a really great paper on mortgage lending at banks and credit unions. And he finds that folks that borrow with credit unions actually end up paying better mortgage rates and have better outcomes over time. And this is even more so actually for folks that go to the larger credit unions compared to the smaller ones. So there could be also some combination of the mission as well as benefits of economies of scale and cost effectiveness at the larger institutions.
Yeah, it's really kind of getting the juices flowing here. I can think of a bunch of different angles we could take to that. And as you just mentioned, this is not solely a UW-Madison exercise. The other schools that have been involved in this, is it more the schools or is it the specific professors that really have expressed the interest?
Yeah, there's kind of three main organizers. Myself, as I mentioned, Andres, he's at Northeastern, and then Dawit Kebede, who is a senior economist in America's credit unions. We actually did our PhD together at UW-Madison. But then, of course, many of the presenters are from various institutions. So we had a really great PhD student, Olivia Wilkinson from the University of Wisconsin-Madison Economics Department. We had Agustin Hurtado from University of Maryland with his co-authors from Georgetown. And then, of course, we have Anna-Leigh from Samford University. And so quite a few universities represented in the presenters and discussants.
And we had a really robust conversation in the chat window as well, and a lot of immediate feedback that came in. I mean, and in a perfect world, I'd love to even get into further, like you said, Anna-Leigh, the extent to which these effects are because there's a tendency for it to be an attempt to kind of expand the portfolio of the credit union in the small business and commercial side, and to what extent we could actually take a look at how that actually changes things. And it becomes at some point, and we're somewhat limited in exactly how much granularity we get in the data that's publicly released, but great analysis of really interesting stuff. In terms of the workshop itself, I'm sure the next event will be again early 2026. I'm sorry, 27.
That is the hope. Yeah. So we usually start, sending out announcements, I think, in about August, September or so. So definitely keep an eye out. This will be our fifth workshop. So we hope to have it once again in late January 2027. We'll probably keep it virtual for now so that anybody can participate. And we're hoping to get the word out a little bit more this year, maybe post it on some different places. Mostly we've been working through our network, but it's always on my website, and we announce it through our various institutions as well. And we hope to put it on some different listings as well, where you can go and search up finance and economics conferences. So yeah, definitely keep an eye out. Everybody, of course, is welcome. And yeah, we're looking forward to it.
So we'll post the link to, I guess, to your website. It's probably the best way to do that if people want to find out more about what's happened in the past and also to stay informed as it moves forward.
Absolutely, yeah. And folks are always welcome to reach out to me, vanrijn@wis.edu. I'm super happy to always connect with people that are interested in doing research on credit unions. I remember myself doing this when I was a young PhD student. It felt very lonely. So part of what we're trying to do is just kind of create a community of credit union researchers. So everybody's welcome to join that.
And Anna-Leigh, the best way, I guess, again, you have a site on the Samford University URL, or what's the best way to get in touch with you?
That's correct. I have a site on the Samford University website. Happy to talk with people through LinkedIn. My email address is alstone@samford.edu, and just happy to, talk with anyone who might have questions about credit unions or research, or even just other ideas out there that we would like to see explored in the universe.
Well, I'll post the links to both of those in our show notes. Anna-Leigh Stone, Jordan Van Rijn, thanks so much. I really enjoyed this conversation.
Thank you, Glenn. My pleasure.
Thank you so much, Glenn.
Well, since the workshop, and actually since our conversation for that matter, there's a new cause célèbre in the credit unions buying bank space. Alabama One Credit Union, which is about $1.4 billion in assets, announced that it's buying People's Independent Bank of Boaz, Alabama, which is just under $500 million, so about a third of the size right now of Alabama One. I think it's interesting that is Anna-Leigh's home state, so I'm going to be talking to her to get any impressions from her on that one. As she mentioned, it was an earlier acquisition made by her credit union in Alabama that actually kind of brought this whole topic to her attention and led to her doing the research. So, as she said, it's working paper status. I know others are really interested in this too, and I'm sure she'd love to know more. So, if you'd like to find out a little bit more, feel free to reach out to her or reach out to me as well, and I'll get you in touch. With that, another episode of the Big Cast in the books. Again, my name is Glen Sarvati. You can reach me via my firm 154 Advisors. Find me on LinkedIn. Find me at the Best Innovation Group website, big-fintech.com. You'll find all kinds of other great stuff out at Big FinTech as well, including the media tab has all of our past content. The CU Town Hall is out there as well. Check that one out, or go directly to the cutownhall.com website. Our next get together on that one will be on Wednesday, March 18th. Mark your calendar. More on that to come. And as I said, if you're at GAC, this is dropping during GAC. If you happen to still be out there, track me down in the app. Love to say hi. And we've got it seems like it's a really busy year out there. There's all kinds of interesting stuff going on. I'm going to be tracking down, and hopefully over the course of the next few weeks have lots of interesting new conversations for you. Hopefully these are all interesting, and hopefully interesting enough to get you to hit the subscribe button and check out our new content that comes weekly, typically on Tuesdays. Again, my name is Glen Sarvati, and I thank you as always for listening.